On one trading session last week, I had a 25% win rate. I went 1 for 4 on all my trades. I had 3 losing setups and only 1 winning setup, yet I still came out the session with a little under $16,000 in profits. Now, there's a lot of lessons to learn from this session, and in this video, I want to discuss 3 important concepts. The first one is going to go over the trading setup and strategy that I use. The second one is going to go over my risk management system, how I have really small losing trades and much larger winning trades, and how I basically protect myself when I'm looking for specific setups. And then the third one is really something that I see a lot of traders struggle with, and that's how to develop confidence in your trading. What happens is a lot of traders take a losing trade and they get so frustrated, they revenge trade, and then it's just this spiral domino effect for trading setups that they're gonna take in the future. We are our greatest enemy. If you approach the market with confidence, you will lose the fear aspect that most likely is doing a lot of your decision making in terms of opening up and closing positions. So I want to discuss how to develop confidence, because this is a very important attribute that I would contribute to myself in terms of looking for my setups, taking my setups, managing my risk around them, and then coming out green in the long run. So let's first talk about the trading strategy that I use, and this revolves around supply and demand zones, support resistance, along with volume confirmations. So the first setup that I took this day, which was Wednesday, September 11th, was a $3,000 loss. Now, I want to mention that I standardize my risk, meaning majority of my losing trades are between $3,000 and $4,000. That is the amount of risk that I'm comfortable losing per trade when I am incorrect on my analysis. So this trade on Wednesday was a long setup, meaning I was bullish, expecting prices to rally up higher. I took the market long as it was selling off, and I stopped out of this trade for a $3,000 loss. I was going for a $20,000 profit and risking $3,000 around that. It was about a 6.7 to 1 risk to reward ratio. Now, this setup did not work out. However, I want to explain my thesis because this is going to play a vital role in the next 3 long trades that I took. So here we can see the market was holding this pre-market low, and as it broke the pre-market low, we can see down here that the bar where it broke was significantly higher buying volume than selling volume, and the market has a lower wick and a strong green 1-minute bullish engulfing candle. At this moment, confirmed with the volume and the order flow, I was comfortable putting risk on long up down here, targeting the previous level of supply. Well, as you could see, this trade did not work out and my stop loss hit, and I exited this trade for a $3,000 loss. And I was completely wrong on this analysis because the market after this kept putting in lower lows and lower highs, and we had a very strong downtrending session in the first hour after the market was open, and especially after we had rejected this level of supply. Now, the important concept to this strategy is understanding what I call a zero print or a very large seller present in the market. So on this strong sell-off down, on this very violent and aggressive red candle to the downside, we can see number one, it was supported by heavy selling volume, and the market had a quick move down on a 1-minute time frame. Now, on this period, what a lot of people will call this, I'm sure, a fair value gap. However, the concept here is that on this sell-off down, there was significant selling volume present in the market. Now, the way I trade is I like following the footsteps of large sellers or large buyers and getting in on the market when they are present, especially if they are supporting or resisting price. On this strong sell-off, there is what I call really strong selling prints to the downside, and these levels at some point in the future most likely get tested again. They are magnetic forces or levels that the market likes to gravitate towards. So on this sell-off down, on this red candle here, at 54.38, 54.41, and 54.44 on the S&P 500 futures chart, there was this selling volume, one over here, another over here, and another up here at 54.44. There was 0 volume transacted on the offer, indicating the market did not give this level a chance to trade on the offer side or on the buy side. So because of how aggressive the selling was, the market never gave the chance for buyers to transact. At 54.38, 54.41, and then 54.44, we could see in these examples, there is 0 volume getting transacted here on the blue side, which represents buy volume. So because of how aggressive the selling volume was, it never gave a chance for buyers to transact. And when I see this, these are levels the market likes to gravitate towards, or they can act as magnetic forces that at some point in the near future, the market likes to revisit them. So on this sell-off to the downside, my thesis, this is very key for the next 3 long trades that I took, my thesis was that at some point on this session, this strong sell-off 1-minute candle will be tested again due to the volume patterns of buyers not being able to transact there because of how strong the selling pressure was at that moment. So on this sell-off, I was mainly looking for ways to get long. Now, the second trade of this session was a planned $3,000 risk, a 7-to-1 risk to reward ratio, and I cut this trade prematurely prior to my stop loss hitting for a $1,200 loss. Now, I started the day 0 for 2. You could see I got long down here, and the reasoning for this was because as the market was selling off, putting in the lower lows and lower highs, you could see a high volume spike here. You could see the market was very close to my green support level at 54.16, did not hit it, was very close, and I was comfortable getting long down here because of the volume spike, speculating that these selling prints up here will be that magnetic force and the market will rally into them. Well, I was completely wrong on this. My entry was very close to my exit, and I got out of this trade prematurely because the market lacked buying volume after entering. Now, a few minutes later, in fact, less than 5 minutes later, I re-entered with the same thesis, same plan, $3,000 loss, 8-to-1 risk to reward ratio, and I cut this trade for a little over $1,500 in risk. Same thing, getting long at the low, speculating that the sellers up here at the 41s, 44s will trade. Was completely wrong on the timing of this setup. What's crucial here is that these 2 next trades that I took after the first loss was good analysis, just poor timing. What I mean by that is now we have the next setup, and this was the big winner, and I was a little more patient with it. Now, these 2 longs off of this same plan and same thesis, in my opinion, were very good analysis, just I mistimed the move. Now, what I mean by this is, as the market sold off and I took that second losing trade here, the first losing trade over here. Now, after these 2 unsuccessful attempts long off of the same analysis of those selling prints here, I knew my analysis was correct, but I was just mistiming the move. It's very likely, it's a high probable setup that those prints will fill at some point in the future. However, I was getting long, anticipating and speculating they were fill, really without best confirmation. So just mistiming it, I wasn't really so incorrect on the analysis, even though I was taking the losing trades. Now, as soon as the market hits my key level at this green line at 54.16, we could see the market break the level, reclaim the level, and on the reclaim, we begin to consolidate and find support above the previous high. On top of all this, going to a 5-minute chart, we could see as the level of support hit, the 2 volume bars down here, in fact, 3 volume bars, were leaning more towards the buy side because there was more green buying upticks. And on top of this, the volume was significantly lower than the previous bars as the market was moving down into the level of support. When I see a lack of activity or a lack of interest at a level of support, it's usually a good indication the market will reverse, or the odds are in my favor for it to reverse. So it hits the level of support, weaker volume, but despite the weaker volume, it was leaning more towards the uptick or buy side. And on top of this, on a 1-minute chart, the market had broken above this previous high, so we invalidated the higher low, lower low type of structure. And as it broke out above this with strong buying, it then held this level as support and consolidated in this range. With this analysis and all these points coming together, I had more confluence than the previous long setups, and I had higher conviction and higher probabilities in my favor that after this consolidation and after the volume, it would be likely these selling prints now will trigger, if my analysis is correct, that buyers are present down here at my level of interest. And I was correct on this. This was again a $3,000 worth of risk, an 8-to-1 risk to reward ratio, and I closed out of this trade for a little of over $21,000 profit. Longing it down here, and you could see how much profits I missed out on, but I sold at this strong red sell candle to the downside because that's where those prints did fill. My target hit, I I sold at my target. I can't look at where the market went after my target. Yes, it's not a good feeling seeing this market rally another 100 points after I've exited, but I did what I had control over, and the only thing I had control over was following my plan and entering where I had to and exiting at my target. So after those unsuccessful 3 long attempts, the 4th attempt is what paid. And that 4th attempt, which was the only winner of the day, has significantly outweighed the previous losing setups. This resulted in a 25% win rate on this session, a little under $16,000 in profit, but look at my average win compared to my average loss. It was about 11-to-1 average win to loss type of ratio. Now, even if the 2 losing trades that I cut before my stop loss, even if they did hit my stop loss, and let's just call them both $3,000 losing trades, I would have had 3K losses, and I would have been down $9,000 on the session. Now, I'm in a hole $9,000. Number one, yes, it sucks. Yes, it's frustrating. Yes, you could easily get it in your head. But when you have confidence in your setups, and you know what you have to look out for, and you trust yourself and you trust your system, all you need is that one trade. So even if I was down $9,000 off of 3 losing trades hitting my stop loss, I still would have had a $21,000 winning trade, and that would have put me up on the session a little under 13K. So still, even if I followed my stop loss and I got a -1R because I followed my plan, I still would have been up significantly due to the winning trade. Now, if you can position yourself to have these winning trades outweigh the losing trades, this is when you're positioning yourself for success in the markets. Not even 2 weeks into the month of September, I have a 50% win rate, which means I'm wrong the same amount of times that I'm right, yet I'm still up significant on the month, and I still come out majority of the sessions green due to my risk management. If you put yourself in the position to manage risk properly, you're putting yourself in the position to have less headaches, and when you follow a successful system, you're putting yourself in the position to have long-term success. Now, I really want to dive a little deeper into risk management. If this is something you want me to make a full lesson and full in-depth video on, just let me know in the comments below. But briefly, before a trade is entered, you have to know where you're going to exit where you're incorrect, and you have to know where you're going to exit if your plan becomes validated and buyers or sellers appear and you're correct on the analysis. And this is where the market can reverse, and this is where your target has to be placed. Now, I never try to enter a position where I am risking less than a 2-to-1 R multiple, or I'm risking $1 to make $1. I have to be risking $1 to make at least $2 or more. Now, when you do this, you're putting yourself in the position to lose more often than you win, yet still come out of the session or come out of the week or the month green and profitable. Now, what you have to really focus on is that's so easy to just create a risk to reward ratio, create a stop loss and a target and follow that, right? The hardest part is sticking with it and not letting your emotions do the trading for you and not hold past your stop loss. Not get stubborn and overtrade and take 100 different random setups because you want to make the money back. So you have to, it's crucial, and I'm sure a lot of you watching this, and if you can agree with this and you relate to it, just be honest with yourself. Know that it could be fixed. If you hold past your stop loss, I'm sure a lot of people have done this. It is the result of blowing up accounts and taking really large losing trades. There should be no such thing as a large losing trade in your vocabulary. When you implement a stop loss and you stick to that stop loss and you take risk to reward ratios of 2-to-1 or greater, there should be no such thing as large losses. In fact, you should have smaller losses or losses that you've accepted and you are comfortable with, because a trade should not be opened. You should not click that buy button on your keyboard or on your mouse until you've accepted the risk. That way, when you're in the trade, you're not letting your emotions take control and you've already accepted the worst case scenario. Anything better than the worst case, in my opinion, is a win. And before I enter the setup, for example, the trades that I took with risking about $3,000, I was accepting of that. I knew that that was my worst case scenario, that if my stop hit and I was wrong on my analysis, that is the worst case scenario. And I've accepted that before I've entered the trade. If I couldn't accept it, then it's a trade that I should not be taking. So I know that's the worst that can happen. And anything better than the worst is a win in my eyes. It is better to cut the trade for a $3,000 loss, or cut the trade for maybe your risk is $100. Cut it for that loss versus you staying in that trade in hopes it's going to start moving in your favor, or in hopes you're going to make the money back, because that is how you are guaranteed to bleed your account, in hopes you're going to turn it around. Exit the loss when it's small because you've already accepted that loss before entering, before it starts turning out into a really big cut. And when the cut turns into a big one, it's really hard to patch it up and heal it. Now that we've talked about the strategy that I use and the risk management aspect to this can be relatable to any strategy or any risk management you implement. Maybe the minimum risk to reward ratio you want to take is for 5-to-1. As you can see in my trades, they were 6, 7, 8-to-1s. So that makes me in the position that I could have a really low win rate, yet the 1 or 2 winning trades are going to completely make a difference in my trading. So everybody's strategy will be different. That's fine. Everybody's risk parameters will be different in terms of how much you're comfortable risking and losing. But one thing that will stay the same once those 2 variables are constant with your individual trading is developing confidence in your trading. You can only develop confidence if you have a successful system that has been forward tested with small funds or even large funds that you have proven consistency with, and you've implemented risk management around this system. The only way to develop confidence is having a system and having risk to protect you, because those are the 2 things that we only have control over in the market. When we have control over what we can control, this is how we approach the market with confidence. In the Invest to Trade webinar we did, I think last week I was basically talking about how every single day I wake up, I go to bed having confidence because I know what I'm looking for on a daily basis. I know the setups that will make me money in the long run. Yeah, it might lose me money in a couple trades, but I know in the long run it will make me money. I know everything that I have to look out for on a daily basis. So number 1, that brings confidence because I know what works out for me the best. And number 2, I know I'm going to have confidence that if I see that setup and lose on it, I'm confident that I could protect myself with my risk management parameters. So the only way to develop confidence is having the system and having risk. And the only way that we can really develop this is through screen time and experience. It's not something that could be fully understood or learned prior. It's really something that gets developed through years of trial and error, months of trial and error, months of you sitting behind the screens, watching how price action reacts to certain things, watching how your emotions increase or decrease depending on the volatility in the market. Watching that you just took a losing trade. Did it affect you mentally? Did you try to revenge trade and make it back? These are things that you can really understand by a video or by a book, but for you to fully feel it and internalize it, it's something that has to be experienced by you and you only, because we are so unique as traders. Now let's relate this a little bit to like a hobby or a craft. Let's talk about golf. Let's just say you never golfed a day in your life and you really want to take it up because you like it. You enjoy going on the golf course and playing. Well, the first time you go and play golf, most likely you're not going to be really good. And I could speak on firsthand experience. I'm not very good. But as you play and as you get on the greens and start swinging the club and hitting more balls, you're going to develop a different feel to golf that's going to instill confidence once you start playing better. In the markets, once you have losing trades and learn from the losses and take winning trades and you know what works out for you the best, this is how the confidence subconsciously is going to instill in you. I've been trading for 8 years. I still to this day tweak my strategy, tweak my setups, tweak my risk, adjust my position size, learn new things about myself, learn new things about the market. It's the constant journey. But when you have confidence and you can rely on something that works for you so well, this is something you can always go back to, and it gives you a little bit of a clear mind because you approach the market differently. And that's the best advice I could give. You'll develop confidence with a solid system and solid risk parameters, and those 2 things could only be learned and internalized fully with screen time and experience and months, days, years, decades of you sitting behind the markets, trading, and getting a good feel of the markets, because feel and instinct is a very important component to this, because again, it's only internalized, not externalized. The greatest enemy is you. If you can control you, this is when a lot changes, and this is when things will start turning around for your trading, and you will start taking better setups and have profitable trades and profitable months. So I'm going to end the video on that note. If you like this format, let me know in the comments. If you want me to go in depth on any of these concepts in terms of strategy, risk management, let me know in the comments. If you're new to my channel, I would appreciate you to subscribe, drop a thumbs up on this video, but I'm out of here. Peace out.